Mark Draper from Gem Capital. Joining me today is Daniel Moore from Investors Mutual. A lot of talk recently about the Australian property bubble, or the Australian property market being in a bubble, and whether it is or not. And what today we're talking about to what extent does that have a domino effect on the Australian banks? And just interested in Investors Mutual perspective on that issue. Not after whether or not we are in a bubble or not, but perhaps can you give us a bit of perspective on that, Daniel?
Sure. I think we could probably talk about property all day. What I would say is I don't think we're brave enough to say we're in a property bubble right now, but let's say the heat in the market, in the property market today, turns into a bubble and there was an eventual crash. What would that actually mean? And the harsh reality is the banks are very... And
perhaps just one quick question on that. Sure. Definition of a property crash, what sort of...
I'm talking over 20%.
Right, okay.
And I'll explain why that 20%, there's actual reason for 20%. The fact of the matter is banks are very leveraged vehicles. And with the capital rules, probably a lot of people don't realise this, that mortgages get a 20% risk weighting for the banks. And most people look at banks and hear the capital ratio of about 8.5%. But the reality is if you get a mortgage, let's say for $100, the banks only have to hold $2 of capital.
Wow.
$2.
So it's a 50
times leverage. That's how leveraged the banks are.
Right.
So normally people need a 20% deposit. If you don't have a 20% deposit, the banks normally get mortgage insurance.
Yeah.
So let's say I get a mortgage tomorrow, have my 20% deposit, the banks have $2 of capital, and the property market has to fall at least 20% because you've got a 20% deposit before the banks can start to lose money.
Yep.
And let's say you have to sell. The banks have $2 of capital on that loan.
Right.
So as you can see, if we had a crash, it get ugly pretty quickly.
Very quickly.
And with the banks, about 60-65% of the book is mortgages, and the other 35% or 40% is not immune because the property market influences the economy.
Yes.
It's a sense of wealth. If there was a crash, people would spend less, which would affect businesses. So you get bad debts on the business side as well. We're not forecasting a crash or anything like that. But it's more of an illustrative example. And
it's a good example.
Yeah,
just in very simple terms.
Just for people to understand that banks aren't riskless. It's important to consider these risks, even if they are a tail risk, and not just to focus on that dividend yield.
And finally on that, what would be some of the road signs that investors would be looking for which would say we're heading toward a downturn in the property market? What are some of the things that you would notice?
Probably the earliest indication would be interest rates rising. And that's not a direct source. It's a source of stress rather than evidence of stress. And why that's going to be an issue is that the Australian consumer is very geared. If you look at the gearing of the Australian consumer, because house prices are so high, they need to borrow a lot to get into the property market. So the Australian consumer will be quite sensitive to interest rate rises. So if we start to see interest rates rise, I'm not talking 50 basis points, it'll be over 100 basis points, which is obviously not going to happen.
100 basis points, 1%.
1%, which is not going to happen, within the next year or so, but I'm talking more medium term.
Yes.
I'll start to be concerned. There's other things we look at. We can look at mortgages in arrears and things, percentage of books which are in arrears and things like that. We also look at what percentage of people are ahead on their loans with the banks. The banks normally present that at investor meetings. So there's a few early indicators we can look at, but I think interest rates moving up is definitely something to look out for if it moves up quickly down the track.
Yeah. But particularly because Australians borrowed so much.
Exactly right.
Look, that's really good information for investors who, by and large, I think, perceive bank stocks as totally safe investments, which they're not.
Yeah, I think if you speak to most mum and dads, they would have several banks in their direct share portfolio. So it's a function of the Australian market, I guess, because 30% of the index is the top 4 banks. And if you look at any exchange around the world, that's certainly not the case. Australia is quite unique in that example. So I think investors do have to be mindful not to be too over allocated to banks because there is that tail risk there.
Absolutely. Look, thanks for that. Great explanation on the risk in the banking sector.
Sure.
And not forecasting a property crash here, but just talking about some what ifs that you need to think about.
Sure.
Stay tuned for more investment updates.